Yo guys, I'm really excited to be back here on the channel, and in today's video we want to look at how the big institutions, the banks, the market maker trade the financial market using the smart money concept. So in this video we want to talk about Oderblock, which is part of the smart money concept. So stay tuned guys. Yo, welcome back again to the channel. Like we said before, we want to look at how the big institutions, the big boys, trade the market using the smart money concept called order blocks. So what are order blocks? Well, as you can see from my screen, we have some written notes here that explain what order block is and the two types of order blocks. So talk about order blocks. As you can see, order blocks are institutional candles where smart money, banks or market maker place their orders. These candles hold whenever price comes back to it. And basically we have two types of order blocks. We have the bullish OB simply means order blocks, and we have the bearish OB. As you can see, the bullish OB, which is the bullish order blocks, is the last bearish candle before price rally up to break previous swing high. Don't worry, we're going to show you an example what this is and how you can identify it from the market. So bullish order blocks is the last bearish candle before price rally up to break previous swing high, and the reverse is true for bearish order blocks. Bearish order blocks is the last bullish candle before price push down to break previous swing low. It's as easy as this. This is the method that the big institution use to actually trade the financial market with a good risk to reward ratio. Now what this means, let me bring out this brush tool and show you an example what this means. So suppose the market is actually moving up. Suppose we have a price move of this nature. Okay, so suppose the price is moving in an uptrend direction, creating what we know as the higher high, higher low, higher high, higher low. Then we have to identify our swing high and swing low. And if we are to do that, this is going to be our swing high, this is our swing low, and this is going to be our swing high. So suppose the market is moving in this nature, higher high, higher low, higher high, higher low, higher high, higher low, higher high. Then all we have to do is indicate our swing high and our swing low and watch out to see how price play. Now suppose price moves down and then breaks the swing low. This is what we're looking for. So first there must be a swing low and there must be a swing high. Then we watch to see how price, we want to see price break either the swing low or the swing high. Remember we said we have two types of order blocks, the bullish order blocks and the bearish order blocks. If the price should break the swing high, which is this here, this high here, we'll be looking for what we call the bullish order block. We're waiting for price to rally down to the previous market structure and look for the bullish order blocks. But if the price should break the swing low, we'll be looking for the bullish order block. We're waiting for price to rally up to the previous market structure and short the market. So suppose in this case the market brings the swing low here. Now when we talk about the bearish order blocks, the last bullish candle that caused this move down is the bearish order block. So the last bullish candle before the market breaks this market swing low is the bearish order block. So what we look for is we indicate the last bearish candle here that caused this move down. We indicate it. So if we we look for the bearish candle that breaks the market structure, the market swing low. Then we map up that level as our point of interest. So suppose here, suppose this is the last bullish candle before the bearish move that breaks the previous market structure, we indicate it with horizontal tool and indicate it of this nation. Then we watch out for price to rally back to the previous market structure. Here will becomes our point of interest. So the previous the bullish candle that resulted to this pushed down, this bearish move that brings this market swing low, we use our rectangle tool to make it as our point of interest and wait for price to come back to this level. Whenever price comes back to that level, usually the big institution have their sell orders at this level, and that is where they are going to short the market. Whenever price break the swing low, people will usually wait for what we call the retest. So suppose this is the swing low now. After the break, people usually wait for the retest and short the market here. But the big institution will place their order just at the previous bullish candle that resulted to the break of market swing low, thereby taking out the first the early sellers in the market. So after the break of this market structure, we have to wait for price to rally back to the previous market structure, and then our point of interest is going to be the last bullish candle that resulted to this push here. So in this case, we have to wait. Okay, here it is. So we have to wait for market to push back here and short the market from this range. So this is the right place to short the market. So whenever we have a break of market structure, we have to look for the last bullish candle or the last bearish candle, depending on the direction of the market, either the last bullish candle that resulted to the bearish move or the last bearish candle that resulted to the bullish move that break the market swing high. So as in this case, this is the swing low, this is the swing high, and then market break through the swing low. So we have to indicate the last bullish candle that resulted to this move here and wait for price to rally back to that range, and then we short the market. Usually we take our position at the 50% fib level of the bullish candle, 50% fib level of the bullish candle, with our stop loss just above the wick of that bullish candle that resulted to the bearish move. When we are using this smart money concept, this Oderblock, it actually gives us a sniper entry, and it helps us to have a good risk to reward ratio. So in this case, we take our entry here, and then short the market down with a good risk to reward ratio. So this example here is the bearish Oderblock. The reverse is the bullish Oderblock. So suppose the market is actually trending down. Suppose we have a trending market. So suppose we have a trending market of this nature. Then all we have to do is so suppose we have a trending, so suppose we have a downtrend market, the price moving to the downside. All we have to do is to identify the swing low and also to identify the swing high. So we bring out our two. Let's say this is the swing high. No, I don't want to use this. Let's use this instead. So we have the swing high here, and let's say the market started retracing to the upside. So we have the swing high and we have the swing low. we have the swing low. So like we said, we have to wait for the market to break either the swing high or the swing low. So whichever direction the market goes, we have to wait for a reverse to the market structure. So let's say the market breaks this swing high. We are looking at an example of the bullish order block. So let's say price rally up and breaks through this market swing high to the upside. So what we have to do is we have to look for the last bullish candle that resulted to this push up. The last bullish candle that resulted in the break of the market swing high. That bullish candle is what we call that bearish candle. Rather, we have to look for the bearish candle, the last bearish candle that resulted to this push to the upside. That bearish candle is what we call the bullish order blocks. So we wait for the market to rally down again to the previous market structure, and our point of interest is going to be at the 50 pip level of the last bearish candle here that resulted to this push to the upside. So let's say, for example, so as in this case, as in this scenario, we have to wait for the market to push down to this previous market structure and indicate our point of interest, which is the last bearish candle that resulted to this push up to the upside. So if the candles appear to be here, we use our rectangle to mark it as our point of interest. So this becomes our point of interest. So all we have to do is to wait for price to rally down again to this previous bearish candle that resulted to this bullish move that breaks the market swing high. So wait for the market to come down to this level, and this is going to be our point of interest. We'll be looking to long the market at this very level with our stop loss usually below the wick of the bearish candle that resulted to this massive push to the upside. So in this case, let's say okay, so we have to wait and see a move of this nature to this previous bearish candle that breaks the market structure, and then this is what will happen. This is what will happen. So this bearish candle here, this last bearish candle that resulted to this push is what we call the bullish order blocks. Now this might actually take some time, but once you are able to get it right, it usually gives a good risk to reward trades. Usually using this smart money concept, it gives you above 1:5, 1:5, 1:12, 4:20, and so on. Remember, if you are in my Telegram, I did drop a trade on Euro JPY and GBP JPY that gave us about 1:20. We actually reached 16 pips and we were able to secure 324 pips. I'm going to show you guys. I did drop a trade in my Telegram channel, and if you're not in the channel, kindly share the description link. Kindly share the description. The link is going to be there. You can join us, and also do it to follow us on our social media, Twitter, Instagram account. Now let's show you practically how you can trade using this smart money concept order block using the real time chart. So I'm going to show you guys. As you can see, this is Euro JPY, and presently we are on the 15-minute time frame. Now, making use of this strategy, the smart money concept, the order blocks, it does not really matter which time frame you're using. It means you can actually use the 4-hour time frame to locate your order blocks, and then you can move down to 15-minute time frame to refine your entry. Now let's go to the real time chart and see and look for these bearish order blocks and bullish order blocks. So let's just make use of EJ rather. So this is Euro JPY, and as you can see, We are here on Hero JPY chart. Let's try look at this. Let's see if we can actually spot the other blocks here on the reach chart. This is Hero JPY time frame. Let me remove this. So here on the Hero JPY, we're actually on the 15 minutes time frame. So the first thing we have to do, like I said, we have to indicate the current swing high and current swing low of the market. So here is our swing high. Here is our swing high, and here was our swing low. So here on Hero JPY, this here is our swing high and this here is our swing low. Remember, market has to break either the swing high or the swing low. So as we can see here, the market came down and broke and actually breaks this market swing low. So we have a break of market structure here at this level to the downside. Usually people will wait for a retest to this level and short. So in this case, what we have to do is that after the market breaks the swing low, we have to look for the last bullish candle that resulted to this break of market structure. That is it. That's what we look for. The last bullish candle that resulted to the break of market structure. Sometimes you may actually have two candles there. Then we look at the one that is close to the market swing low and the one that is a bit far off from the market swing low. Now, as in this case, we have here a bullish candle, then we have here a bullish candle. Usually, if the bullish candle is actually, if there appears to be two bullish candles before the break of market structure, the one that is usually close to the market structure, to the swing low or the swing high, doesn't really hold. So we go for the first one, and as in this case, here was the first bullish candle that resulted to the break of this market structure, that resulted to the break of this market swing low. So we have to mark that as our point of interest. So we make it our point of interest. So here is the bullish candle that resulted to this rally down, this break of market structure here. So after the market breaks through this previous market low, we have to wait for a retracement back to this candle. Then here is going to be our point of interest with our stop loss just above the wick of the last bullish candle that resulted to the break of market structure to the downside. So in this case here, this is the last bullish candle, so we have to wait here for the market to come back to the last bullish candle that resulted to the break of market structure. Remember, we said our entry should be the 50% of the last bullish candle or last bearish candle, depending on the direction we're going. So as in this case here becomes our point of interest, our POI. Okay, so here becomes our POI, our point of interest. POI, let me reduce it to, let's say, 12. Okay, 12 is still too big, but it's fine. So here becomes our POI, our point of interest. So trading is a thing of patience, it's a game of patience. So we have to wait for price to come back to this level. So we extend it. So here the price actually came. Remember, we have two bullish candles here. This was the first one. Price came here, did respected it a bit, but mark the boost we are seeing in the market, so they took price back to our point of interest, which is the first bullish candle that resulted to this break of market swing low. So notice what happened here. Market got to this level here. Remember we said 50%, which is here at this level, and then we take our entry. Okay, this is too big. All right, so with our stop loss just above the wick of the bullish candle. This was the exact trade I actually sent to my Telegram channel, this Shiro JPY. Here we actually risk I think it was about 6 pips rather, and we got 324 pips. We were able to risk just 6 pips to cash 324 pips. It was really massive, and this can only be done using the smart money concept. So as you can see here, price came back to our point of interest, though it took some time, but price came back to our point of interest, and we short the market here, and we actually caught a lot of pips down, way down. We caught a lot of pips way down. So this is how to use this smart money concept, the order blocks. You have to locate your swing high and your swing low, wait for a break to the upside or downside, and look out for that bearish candles or that bullish, the last bullish candle that resulted to the break of market structure swing high or market structure swing low. In another video, we'll show you more examples on how you can trade using the bullish order blocks and the bearish order blocks.